Hello everyone, welcome back to CPK Books and Accounts. In today's video, we will understand one of the most important concepts in US payroll, that is Social Security tax. We will cover what is Social Security tax, what is FICA, tax rates, wage limit, payroll example, Form W2 and 941, common payroll mistake. So let's start. Now, what is Social Security tax? Social Security tax is a payroll tax in the United States. It is collected by the US government to provide benefits to people after retirement or in situation like retirement income, disability benefits, survivor benefits for family member. This system is managed by the Social Security Administration. In simple meaning, if you'll say, employees contribute during their working years and later they may receive benefits after retirement. Moving on to what is FICA. Social Security tax comes under FICA. FICA stands for Federal Insurance Contribution Act. Under FICA, there are mainly two taxes, Social Security tax and Medicare tax. Now talking about the Social Security tax rate. Currently, Social Security tax rate is 6.2%. It's 6.2% contribution from the employer side and the equal contribution from the employer side as well. So the total should be 12.4%. Here you can see where I have mentioned explain. It says that employee pays 6.2% and employer also pay 6.2%. The total contribution becomes 12.4, and this 6.2% or can say 12.4% will be deducted on total gross salary. So we'll discuss about the wage base limit as well. There is a wage limit up to which the Social Security will be deducted. So if we'll talk about in the term mentioned over this PDF. So this is one very important concept is the Social Security wage base limit, which is 1,84,500 in 2026. So this wage limit changes each year. In 2026, the wage base limit is 184,500. Social Security tax is not deducted after a certain salary limit. For example, suppose wage limit is 184,500 for a year and you have earned 184,500 in that year. So your Social Security will be 6.2% from employee side of 184,500. So while calculating the payroll taxes, you have to keep one thing into your mind, that payroll follows the calendar year. Calendar year refers to Jan to December. If your salary is 20,000 per month, so and you have joined the company in Jan 2026, so at the end of the year your total salary will be 2,40,000, which is the sum of 20,000 into 12 months. That will be 2,40,000. But as per the wage limit of 184,500, out of that 240 wages, you will pay the Social Security tax on 1,84,500 only. So the 6.2% will be deducted on behalf of employee, and the same percentage will be deducted on behalf of employer. So we will discuss an example as well. Suppose employee's monthly gross salary is 5,000. So Social Security will be deducted 5,000 into 6.2%, that is 310. 310 will be deducted on 5,000 salary. Your salary is 10,000, then it will be deducted 6.2 on 10,000. And also, for example, you have joined the company in December 26 and you earned $1 lakh in a month. So the very next month, Jan 27, your salary is again 1 lakh which you have received. You have not received. The gross salary of Jan 27 as well is 1 lakh, which means in 2 months you have earned 2 lakh. But this 184,500 limit will not apply there. Why? Because the first month falls into 2026 calendar year, Jan to December. So the amount received, the amount considered as gross salary in Jan 27 will be the part of 2027 payroll. I hope this is clear to you. Now moving on to where does this appear, this specifically this social security tax. So first it will appear on form W2. Form W2, employee can see social security in form W2 where wages have been mentioned and tax withheld has been mentioned as well on form W2. So this is the form W2 refers to the income proof form for an employee, and this will be issued by the company to the employee. And the second form 941, employer reports payroll taxes quarterly using form 941. This 941 includes federal tax withholding, social security tax of employee plus employer, and Medicare tax of employee plus employer. So I'll explain everything in the separate video for Medicare tax and separate video for federal withholding tax as well. Now the important points at the end: social security has wage limit, and the person who is getting salary will pay the employer part as well and employee part as well. This will be included, the employee part will be included in your gross salary, but the employer part will be out of your gross salary. For example, if your gross salary is 10,000, so you will pay social security, so employer will contribute 6.2% of 10,000 separate than the gross salary. So we'll discuss about the common payroll mistakes as well which one do. So mistake 1 could be wrong wage limit application. For example, the limit is 184,500 for 2026, but someone thought that the limit is 176, and after 176k someone has not deducted the social security tax of an employee. So this will be wrong. Mistake number 2, not stopping deduction after annual limit. Mistake 2 refers to for example, like the wage limit is 184,500, but an employee has earned 200k in a year. So the mistake has happened that the social security tax should have been deducted up to 184,500, but the tax has been deducted up to 200k. So this is another mistake. Then mistake 3 is incorrect employer matching. So the percentage of employee contribution is 6.2%, and the same for employer as well, that is 6.2%. But the mistake could be employee portion mentioned 6.2%, but employer portion mentioned 6.4, 6.5 or 7.6. So that could be the mistake number 3. And these mistakes can lead to IRS penalties, because IRS is you are submitting your quarterly returns to IRS, and IRS is also reconciling the records which you have submitted and which employee will file while they will file the taxes at the year end. So at that time, if IRS find that some reports have not been correctly submitted, so at that time you can receive the penalties as well. And if we'll talk about the real life understanding, think of social security tax like a future benefit contribution. When employee retire, the government may provide monthly retirement benefits based on their earning history and contribution. And not only about the retirement, before we have discussed about the other uses of this social security as well. This can be used as an disability benefit if someone is not able to work, so government provides the funds to them from the social security tax, which is contributed by the working employees. And also survivor benefit for family members. So if the earning member of the family is no more, then government provides them some funds as well. That could be the help, we can say help to the family from the social security fund, and that social security is contributed by the working employees. So I hope this video helped you understand US payroll social security tax in a very simple way. If you found this video useful, like the video, share with friends, subscribe to CPK Books and Accounts channel, and comment below which payroll topic you want next. Thank you.